a lot of you guys are in different points within your business, right? And we work with companies throughout the country within the industry that ranging from just starting out all the way into the eight-figure range. So I hope that this presentation can give you guys a perspective into maybe some of the bottlenecks that you're facing on the accounting side, because you guys all have goals, business, personal goals, right? And you don't want accounting to be the bottleneck to any of that. So, and I hope this kind of helps out here. My name is Joe, as Wesley mentioned, my wife and the other co-founder, Carla, here as well. So the first stage of business, the person in the field, right? So you're doing the work, you're pretty much doing everything, right? And this is the time to really set the foundation for scaling. Even though you may think that you don't have necessarily the funds to make certain investments in the company, it's really better now to make some of those decisions, implement some of those systems, because as some of you that have grown your business have seen, as you've grown, it becomes a little bit more challenging if you do want to change a process or a system. It creates a lot more work towards it. So when it comes to the accounting system, right? So opening up a business bank account. Within the business bank account, opening up accounts for specific reasons, whether it's running payroll, year-end taxes, setting money aside for sales tax. Also, making sure that you're separating business from personal expenses. Many of you have probably heard that before. And it's not just for the IRS, but also, so when you're creating your budgets in SynkedUP, you have accurate information, and personal expenses aren't looped into that, where now you're overcharging your customers because now you think that you need to recoup all these extra personal expenses.
Yeah, and if you have personal expenses running through the business bank account, what that does is it dilutes your equity, and the equity in the company is very precious to you, right? It's basically what your company is worth at the end of the day, the value of the business. And so personal expenses decrease equity in the account on the balance sheet. So that's another reason why you want to stay away from running personal expenses on the business bank account.
Yeah, and this is also the time when if you set up maybe an LLC, you're going to want to think about, okay, how am I going to be taxed? The default will be a sole proprietorship. Maybe as the company grows, move into an S corporation partnership.
Yeah, usually when your accountant set up your business, usually they'll stick you in sole proprietor, single member LLC when you first start out. And basically what that means is you're going to file your taxes on your personal income taxes on your 1040, and it's going to be a Schedule C in there. It's going to be one return, and that's what's going to be filed. But as you grow your business and we get into the next stages, we want to think about kind of switching you out of that sole prop and more into an S corp or partnership, just depending on what your business goals are. And we'll talk about a little bit about that moving forward.
Within your accounting system, one of the initial things is setting up the chart of accounts. It's like the foundation and almost like the buckets that all of the banking transactions will get categorized into. And this is important because if you do things like benchmarking your numbers to industry averages or trying to compare it with maybe your friend's business, at least you understand when you are going to be comparing apples to apples.
Yeah, having a specific green industry chart of accounts set up on your QuickBooks is going to make sure that when you look at your gross profit on your P&L, it's actually specified to this industry, and you're not just looking at gross profit in general, what QuickBooks has set up already for you when you buy that account, right? And like Joe said, it's the buckets that your business transactions go into. So let's say that you load up your truck in the morning, you stop at a gas station, that's going to come through your QuickBooks account. That's going to be coded as fuel expense, right? The next day you go out and buy a skid steer, you have to record that transaction. That's going to go in as an asset on your balance sheet, and you're going to be able to depreciate that for tax purposes at the end of the year. So all of these business transactions have to be recorded, and the method that you're going to use to record them is going to be using chart of accounts, but specifically green industry chart of accounts, okay?
And this is what a chart of accounts would look like, and we could even email this to you guys as well.
Yeah.
just so you have it.
We have an Excel file, and you guys can just upload that into your QuickBooks if you would like to use that standardized chart of accounts. And next up, at this stage of business, you're going to start doing your bookkeeping, right? What does that mean? Like we said, you're going to go in and, most of the industry, I would say like 90% of contractors use QuickBooks Online, right? So you're going to connect your bank accounts, your checking, savings, credit card accounts to QuickBooks. It's going to download all your transactions in there daily, and you're going to log in and categorize all those transactions. So if you have a deposit, maybe you categorize that as sales or income, right? Expenses as fuel, job site materials, and so on and so forth. And at this stage of business, you'll want to do that once a month, right? Once you get into the later stages of business, maybe you want to do it weekly or even daily. But at this stage, it's important to do it once a month, and then you're going to go in and reconcile your bank accounts. So what that means is everybody gets a bank statement, right, at the end of each month for the month, and you see your beginning balance and your ending balance in your bank statement. And what you're going to do is you're going to plug those numbers into QuickBooks, and you're going to make sure that QuickBooks mirrors what's in your bank account, and that's what's going to make sure that everything is reconciled. And in essence, that's what you can feel confident that your P&L is accurate. If you don't reconcile, then you can't feel that your P&L is going to be accurate, because you may be missing transactions that are miscoded, and this could lead to over or understatement of income and expenses. Next is payroll. So at this point of business, you may be a little bit confused. I talk to contractors all day. They're like, should I set up like W-2s for employees, or should I classify them as subcontractors, right? And according to the IRS, if this person is under your direction, they're using your equipment, they're following your schedule, right? Then that person is considered a W-2 employee. But if they're not following your direction, if they're going out using their own materials, their own equipment, you don't have that much control over them, then they could be classified as subcontractors. That's not a problem. So if you do determine, okay, I do have like a W-2 employee, then this is the point where you'll want to get a payroll provider like Gusto. They're a really good payroll provider that they're going to file your payroll taxes and W-2s and get all of that straightened out. And basically, for your subcontractors, you may go a different route. You could issue like a manual business check to them, like from your business stock, and write their name on them, and on the memo line you can write subcontractor. But you will have to have a W-9 form so you can file the 1099s at the end of the year, because this is very important. If you don't have their W-9 form, you cannot deduct it as a business expense at the end of the year. So what does that mean? You're going to lose out on all those expenses for your subcontractors, and that's going to go through as it's going to look like you have a lot of profit at the end of the year. And I've seen that happen a lot of times to people where they didn't have this properly filled out, and we had to put it as owner's draws, and you don't want to be in that situation. But you could also do it through Gusto, like a payroll provider, and pay your subcontractors through there as well. Or you could use a manual check if you have a W-9 form. And of course, you always have to have workers' compensation insurance too. Then you have your tax obligations. I would say at this stage of business, you probably feel a little bit overwhelmed on like all the taxes and everything that you have to file for compliance purposes. And these are the three most important taxes you have to be aware of. So the first one is state taxes or franchise taxes. So this varies on state to state, but basically it's just an information return that you have to file annually. So visit your state tax website, and it'll say there what your state's requirements are for franchise taxes. And then there are your year-end taxes. So that's your 1040, your Schedule C, your S-Corp, partnership, corporation returns, the business returns. And then you have sales taxes. A lot of Hardscaping services are not really sales taxable in most states, but I would encourage you to visit your sales tax state's website to see if your services are sales taxable. And what I've done a lot is I call them up too if I'm unsure, and then get a written email from them, just making sure that you have something that proves that, okay, my services are not sales taxable, I don't need to remit this to the state. And sales taxes are due annually, it could be due quarterly, monthly, it just depends upon your state and kind of the revenue size of your business.
Stage one is done. And remember with that, just being proactive and setting the foundation, right? Stage two, the person in the office. So this is a change, right? And this is when, typically we see a lot of companies, maybe moving over from maybe a sole proprietor to an S corporation. In that scenario, making sure that you're paying yourself a reasonable salary for the work that you're performing in the business.
Yeah.
If you are still a sole proprietor, then that specific situation, the business's income will be your personal income, and you'll get that through the owner's draw.
An S corp is advantageous because you save money on self-employment taxes, which is about 15 to 16% of your net income, and that adds up to a lot. So I would talk to your tax accountant about switching over to an S corp at this point. And I like the person in the office stage because I feel that this is where we see there's most opportunity, because we see overhead expenses just through the roof in this industry, and we want to make sure we get those down. Especially overhead salaries is where a lot of people struggle in. And so when you're at this stage of business, I want to encourage you to come up with processes and systems and look at some of the softwares to really be able to streamline this stage of business, but we'll get into that a little bit more further here. And yeah, so starting off with the accounts receivable, this is what people owe you, right? Your clients, what they owe you for the services that you provided, okay? So you need to have a process for this, because although at this stage you're the one doing all the invoicing, collecting all the payments, running around, you're not gonna be in this stage forever. You're gonna hand this off to someone someday. And if you don't have a process in place for when you do that, it's gonna be an issue. And that's because you wanna get paid, right? We all wanna get paid. And what I encourage is for you to review, part of your process is for you to review your AR aging report on a weekly basis. This could be done on QuickBooks Online or whatever wherever you're invoicing on online. And if you review this on a weekly basis and you keep notes on each client and where they're at and when they're gonna pay you, then each week you'll be able to catch those items, and you won't be wondering when you're gonna get paid and stuff like that. You also need to have a policy on your collection terms, right? So do you cancel services after 30 days of non-payment, 60, 90? What does that look for you and your company? I always recommend 30 days, okay? So is your first step to call the client, text them, email them, or do you send a letter first, right? All of these processes have to be written down somewhere so that you can follow them, and that person that's gonna take over for your next, they have something that they can follow, and you can hold them accountable to that. Because I'm gonna tell you guys something I see often. When we calculate key performance indicators on AR and AP, we calculate the days, right? So AR, we see, let's say we see 40 days. So what that means is it takes the average contractor 40 days to receive payment from clients, okay? Then when we go to the accounts payable, this is when you're paying your vendors, so you go to site one, how quick do you pay them? And we see that at 30 days. And that's not good for cash flow. You're paying your vendors before you get paid. And then you're like, where's my cash? What's going on? Why am I cash flow poor? And it's because that's where most of the industry is at right now. They're backwards in that mindset. You need to be getting paid first 30 days, and then you pay your vendors in 40 days. And that's what happens when you don't have these kind of processes in place for you and your team. But yeah, getting into accounts payable, that's why it's equally important to review that on a weekly basis. Who do you need to pay out? Looking at who you do business with and what their credit terms look like. And you could always negotiate with them. Like if they're offering 30-day terms, but you need 40 days, and you've been a good client and stuff like that, you can build that relationship with the vendor or look for other vendors that are willing to work with you through that.
Yeah, and these two items have a big impact on cash flow, which may not necessarily be in your profit and loss statement, right? So it's something to definitely consider. And at this stage of business, we recommend at least once per quarter meeting with an accounting professional, and then also making sure that you're getting reports on a monthly basis. Instead of just for tax purposes at the end of the year, you want this information for managerial decisions throughout the year to make some moves. Also, now that you're in the office, that's great, but you want to make sure that before you leave the field, and spend more time in the office, that you have a very clear understanding of, okay, what are the production rates in the field? How am I gonna hold my employees accountable to that? That's big. That's something we see a lot where people come into the office, but then things start to lag a little bit behind in the field. So you wanna get that process down. This is an example of something that we would track for a company.
Yeah.
And looking at field labor as a percent of the total revenue, right? For this specific company, it would be around 20%. That would be around like the rolling 12.
And what happened with this particular company, like you see their field labor efficiency was really high, and then in February it dipped down below to the negative. And it's because they were keeping employees on throughout the non-busy season, or when they had less contracts in place, just to kind of hold them over until the busier season came along. But as you can see now, they're performing well. But what if they weren't? What if that trend kept going down? You want to know about that, and this is just like a nice visual way to kind of see how your field laborers are performing.
Yeah, and in a seasonal business, it's important to not only look at the month to month, because that can change, but looking at the rolling 12 months. So no matter where you are in the year, being able to look back and see, okay, where is this number at? Also, in this, for a company in this stage, you're not going to be able to hire a full-time, marketing person. As Jeff mentioned earlier, you want to stay consistent with that marketing, but how can you do that when you're handling a lot of different things, right? You want to maybe look for fractional staff, part-time staff that can fill that gap. You want to be able to leverage other people's expertise in this when you're at this size of a company. And then also, as Carla mentioned, in the slower times, you got to be careful of those fixed expenses, because that's what's going to cause some of the cash flow problems for you. So things like, having a flexible marketing spend where you can maybe dial down a little bit in the winter, renting equipment at times. Maybe if you're not going to use it as much, in the off season, you'll be able to not have to pay for some of that fixed expense. So just all some ideas. And then at this stage of business, you want to make sure to really understand your financial statements. It's big. And if you don't have a good idea of it, we have some YouTube videos that you can look at and kind of, review as well. Stage 3, and we have a lot of information here, guys, and I'm definitely going to send you guys the PowerPoint as well. But this is when the person's now doing primarily sales stuff, right? And with that being said, sales brings more revenue, and now you're hiring more administrative staff, and you're going to want to make sure that, just like in the field, that you're giving your field employees, or you're putting them in situations where they're trained on it and they understand and they're efficient with it. You want to do the same with your administrative team as well. So matching whatever their skills are with their tasks that they're doing as well.
Yeah. And I had a client that I was working with, and they told me that their manager goes out and buys all the materials and runs from job site to job site, and that wouldn't be like a good example of matching somebody's pay rate with their skill level, right? So instead, like they implemented something else where they had someone who got paid less to do that job, and now the manager could just focus on clients and project management at that point.
Yeah, and also making sure that your team in the field is on the same page with the administrative team as well, because there's some things that they need to work together on to make sure, and they need to understand how their role impacts the company financially as well. And with the administrative salaries, as Carla kind of touched on briefly, that's something that you really want your revenue and your gross margin to guide those kind of decisions. You're only going to be able to afford so much overhead salaries based on the size company that you are. So a $300,000 company, they're not going to have as much as, let's say, a $1.2 million company, which may have maybe roughly $120,000 that they can allocate to that. For the companies we work with that do a lot of the install-based work, so far this year they're at about 8.8% of total revenue for those overhead salaries. So think of that as kind of all of the people that are not directly performing the work in the field.
Yeah, that's a good benchmark to look at, that 8.3 to 10% of overhead salaries that you should be spending as part of your revenue. And just really breaking it down into those roles that Joe had up on the screen.
At this stage of business, you may want to think about monthly meetings instead of quarterly meetings. And with more sales comes growth, but that has an impact on the company. So growth typically takes up more cash. You may have to be buying assets at a faster rate. You're also training people, right? So they're not going to be as efficient as a company that is not growing as much and they have established, field employees. You may have to take on more debt, which can, definitely affect your cash flow as well. So, these are all things that you should be considering if you're looking to grow your company faster. And with that as well, because you're growing faster, there's more risk associated with that. So just like being able to see the information monthly, you're also going to want to be seeing it by service line as well. If you have, maybe maintenance division, hardscape, stuff like that. Also, if you're spending money on marketing, making sure that you're not associating that as much with the top line revenue growth, but you're also holding yourself accountable to the net income that you're generating as well. Also at this stage of business, looking at cash flow, we spoke about this a little bit last year, how there's a lot of aspects of your business financially that are not just looking at your profit and loss statement and your operating expenses and revenues, but there's things like investments into the business as the owner, or asset purchases, loan payments, all of these different things that have an impact on your cash flow that you should keep in mind as you're kind of thinking about, okay, how am I going to forecast this out?
Yeah. So on your P&L, you may be making like a 10% net profit, right? But that's not all the money that's in your bank account. Because you haven't taken into account like your loan payments to Sheffield or Ford, right? Or maybe draws that you're taking out for yourself personally, because that's not on the profit and loss, that's on the balance sheet. And so by the time you take away all those expenses, you may be left with like 2% net cash flow, right? Which is pretty low. So that's why it's important for you to look at your balance sheet as well and your cash flow statement.
Yeah, and if you do see yourself running into cash flow issues, you can forecast it out, right? So use some assumptions that you may have, whether you're going to be adding equipment or adding additional staff, maybe doing a price increase, and then using some of the historical information, current growth rates, so how fast are you growing within, not just comparing it to last year, but okay, how do these previous 3 months look? Am I growing?
Yeah, because a budget is different than a cash flow statement. So at this point, you may have a budget that it doesn't change from month to month. Like you created this budget in December for the next year, right? But a forecast, that changes every month because it moves with your business and it's forecasting based upon the current trend. So you want to have these two things in place. One is a cash flow forecast that's going to help you be able to see the cash flow in the business. And two, the budget that's more like for operation and production purposes.
And you can see here, so for the benchmarks of the install-based companies right now, net cash flow so far this year is actually 2%, right? So it's something you definitely want to track. Stage 4, the general manager. And we'll take questions at the end, all right? Thank you. Just trying to get through some of the stuff here. So for the general manager, so now you have a more developed team administratively in the field. You're going to want to not just use a great project management software like SynkedUP, but also use things like Zapier that sync with it, or use some of the other softwares that are available for some of the other functions within your company. And also, as the manager, now you're going to have some of this data to make important decisions, right? So are you purchasing equipment and vehicles? You can look at things like, okay, how are my repairs and maintenance doing? If that's slowly increasing over time, that could be an indicator that, okay, maybe it's time to kind of look at this stuff. How is the return on the current assets that you have, right? So just as you would look at an employee and the income that they're generating, how much income are my assets generating me? You can see the industry average or median is around 32%. Leverage, so am I over or under leverage when it comes to debt? Asset usage, looking at some of those ratios as well.
Yeah, and we try to make it easy. Like if you look all the way to the right, the percentile, 1 and 2 means that you need an improvement in that area, and then 4 and 5 means you're rocking it. You're knocking it out of the park there. So it's pretty easy to kind of see in this report kind of the things that you would need to focus in on in the business.
Absolutely, and another thing that you guys should be tracking as well is how much reserve cash do you have, cash on hand, right?
Yeah.
Typically, we recommend having 2 times fixed monthly expenses.
Yeah.
So having a target for yourself and seeing, okay, where you actually, land as well when it comes to making some of those decisions. Stage 5, business owner, right? So this is something where you really want to think about, okay, what is your goal, right? Are you looking to maybe make this more of a passive thing, right? Maybe have, maybe promote someone into more of a managerial role to help, save some of your time, or you're looking to continue to grow the company, buy companies. You want to think about, okay, how am I going to utilize the cash, right? Because having good cash flow will be able to put you in the offense, and whether you want to invest that money back into the company or acquire other companies, it's definitely something you can consider. With a budget, I know that, because a lot of you use SynkedUP, it's a very important part of that, but making sure, month to month, keeping up on that, looking at, okay, what did I budget? What is the actuals? And then what is the variance? What is the difference, right? So just making sure that you're tracking that as well. And then also when it comes to some of the analysis, as the business owner, this is really what you're going to be looking at, right? Some of those KPIs, like the key performance indicators, that you're going to be able to hold your entire team accountable to. So comparing your numbers to previous periods, looking at, okay, what is the trend to last year? In a seasonal business, it's important to look at how it compares to last year, and maybe not as much how it compares to last month, because in a seasonal business, last month could mean that operations were different. Could mean it was in the winter or something like that. So, and then being able to also compare it to maybe the industry average or industry median. And then, as I mentioned before, looking at it by the service lines as well.
Yeah, because at this point in business, like you want to run your company based upon key performance indicators, right? KPIs, and be able to see all that data to kind of think about it moving forward in a strategic way.
Some of you may decide that you do want to acquire a business, right? And this is something you want to be careful with, right? You want to do your due diligence with this. Here are some red flags that we've seen in the past. I know, like things like high customer concentration. So do they have a couple of, customers or even vendors that they work with that if they lose them, how risky is that, because you're going to be kind of, acquiring this business. So you want to make sure that things are a little less risky with that.
Yeah, and a client of ours was looking to purchase another business, and I looked at their balance sheet, and we I did some of the ratios on the balance sheet and stuff like that, and we looked at some of the asset ratios, and a lot of their assets were really old, like they were gonna break down sometime soon. And I said, you're purchasing this business for this price, but you're gonna have to replace all of these in 1 to 2 years. Like right when you buy the business, they were like, whoa, thanks for telling me that. Like it's some of these KPIs, of these balance sheet ratios that you can actually use to analyze a business if you're looking to acquire it. So just a red flag that I just encountered, so.
And also deciding if you want to expand the business, is it worth investing more in reoccurring work or some of the one-time work, like the install-based work. Each has their positives and negatives to that as well. But we do want to leave a couple of seconds here for questions as well. So,
yeah, how many of you? This is my question for you all. There's a lot of information in those slides. It's like,
We're like,
let's not just jump in the pool. Let's just drag you to the bottom and hold you there. But how many of you wrote down one thing that you want to go home with from this presentation? Raise your hand. Elbows above the ears. There you go. Sometimes it's hard to read to see if it's landing. There's your proof.
awesome.
So, who's got a question?
All right, so regarding your comment of 2% net cash flow, can you elaborate more on what you meant by that?
Yeah, so at the beginning, let's say in January, you started off your checking account with $20,000 in it, and in December, you ended with $25,000, right? You want your checking account to increase by the time you end your business cycle. And so that's what we're measuring. That's net cash flow percentage.
I understand that. I think I need to elaborate more on my question then. As an industry standard, what were the size of companies, what revenue-wise, that you're seeing that at? And is there a variable on, say, a company that's 500,000 versus 5 million?
Yeah, so that was for companies.
For that specific variable is above companies in the install base side that are above 500,000 revenue.
Okay, thank you.
Okay, thank you very much, Carla and Joe, for making the trip out here from New York. Appreciate you. And take a picture of that slide right there because you'll need it. Round of applause for Joe and Carla. Thank you.